Hi everybody, thank you so much for joining back in. In this video, we're going to continue talking about chapter 10, which is your chapter about trading styles and strategies. We already covered the moving average strategy, so in this video, we're going to focus on the breakout strategy, and we're going to talk about it in two ways. One with a retest and one without a retest. So let's go ahead and talk about what the breakout strategy involves. The breakout strategy is really a strategy that you focus on when a stock is trading in a clear range and you have already created your major resistance and your major support. And so when you have a range developed for a stock, what you're looking for is either a breakout above the resistance, I'm sorry, this is supposed to say resistance here, or a break below the support. So if a stock breaks above the resistance, then you can start potentially getting into the stock and creating a setup around the breakout. So remember, if a stock breaks above a specific point that it's been rejected at before, then we can start looking at an upside move because now a stock is trading above a level in which bulls or buyers were not willing to pay for it before. So that's what's happening on the psychological side of things. After a stock is rejected, for example, like this one, at $40 once, twice, and three times, the stock finally came around to circle back up and finally break out, and traders or buyers here were willing to start paying more than $40 for it. And so this is a time in which you want to start getting involved in the stock because that upside move may continue pushing higher. Now, finding these breakouts is going to involve a little bit of work on your end. You have to go in and you have to create these resistance points. So whenever I pull up a chart, for example, like this, I would place a resistance point at the places in which a stock has gotten rejected in recent history. For this example, we can see that this stock was rejected at 0.67, which is 67 cents. So I would create a resistance point at 67 cents, and then I would create another resistance point perhaps above another high in case the stock continues pushing and I'm interested in getting into it at a later point. Now, when you do have these alerts set up on your charts, what you'll find is that when you even least expect it, some setups will start coming your way. If there's nothing happening on the market, you can't find anything on your scanners, and you are just kind of watching charts, taking notes, one of these alerts can go off, and maybe you had set it months ago, but the stock is finally coming around to breaking out that resistance. And so when you see it breaking out of the resistance, your job is to now to watch volume and momentum and relative strength. You want to see that the stock first on its breakout has strong relative strength. You also want to see strong volume, such as this one here, and you also want to see overall signs that the stock is moving in a proper way, and if there's any catalysts that are driving the stock to make that breakout happen. A lot of times on penny stocks, the way that they finally get to break out is there's some kind of outstanding catalyst that will push them for that day or maybe that week, and that's when it's time for you to strike. And this breakout will work on penny stocks. It'll also work on normal shares that you want to trade on Apple or Microsoft. So it's not strictly about penny stocks. If you are looking at Apple, for example, and you want to find a breakout point, you're going to look into its history and you're going to figure out which resistance point is worth getting into when the stock breaks above. And this is going to vary depending on the time frame that you're watching. So say for example, you're looking to trade the stock for days or weeks. Then you're going to look at the daily or weekly chart. So remember exactly how we applied the same time frame rules in our last strategy. You're going to apply the same rules again here with this strategy. If you're looking to trade a stock for days or weeks, then you're going to place the strategy around the daily or weekly time frame. So if you are looking here in this case to trade Apple for days or weeks, then you're going to find the most recent resistance points in which the stock got rejected at on the daily candles. So here in this case, we can see that Apple yesterday got rejected at 150 and 90 cents. Let's call that 151. So we're going to create a resistance at that point. And so in the case that Apple breaks above 151, now we can start potentially looking at an entry point for the stock. And what will happen then is once the stock breaks above 151, we're going to place a stop loss somewhere just below that level. So if you're not utilizing the moving averages for your stop loss support and resistance points, then you will not be utilizing them in this strategy, because this strategy applies to a whole different set of rules. But you can also combine the two when you do get more proficient at combining the two in your own specific trading style. However, for this specific strategy here, we're ignoring the moving averages. We're going to get into the stock at the 151 breakout, and we're going to place a stop loss just below 151. And the reason why that is because remember, psychologically what's happening here is that once the bulls see that the stock has moved above its resistance, they're going to want it to stay above the resistance, because they want to see that buyers are now willing to pay more than that price for it. And because the moment it moves back below that level, that means the people who bought it up to this point are now giving away their positions and starting to move it back down. So when it does break above 151, now we want to potentially get into the stock. Now you'll also notice that some resistance breaks are more significant than others. So not all breakouts are created equally. For example, with Apple, if it breaks above 151, you're going to see that it has another resistance right here at 151.70, and another at 152.80, and another at 153.65. So yes, the stock above 150.90 or 151, yes, that's a breakout. However, a breakout above this level here would be a lot more significant, because this is a strong rejection level that you can see took the stock down for 4 days, all the way from 157 to 135. So when a stock breaks a point in which it's gotten rejected at very, very strongly before, that's a point in which you want to pay more attention to and potentially place higher price targets on. So you want to see, how was this rejection treated in the past? Was this stock significantly rejected at this price point? Was this stock sort of rejected at this price point and it just consolidated here and then it broke back above? Is there a close enough resistance that we would need to place another breakout need for the stock on? So for this example, you need this breakout and then this breakout and then this breakout and then this breakout for it to really move to that 157 mark. And there's nothing wrong with taking the stock from this breakout to this breakout here. So for example, if it breaks 151 and it moves to 151.80, if you are trading a call option on that breakout, then you're probably going to make 15 to 20% on that call option scalp. So there's nothing wrong with that. But the idea here is you want to understand that not all breakouts are created equally. You have to gauge what kind of breakout or how long this breakout can run or how far it can go by the most recent resistance points that you can find and how hard the stock has gotten rejected on them before. Now, breakouts can go either way. Remember that breakouts can be to the upside, or you can have breakdowns. And breakdowns is not really the proficient word to use for it here, but when we break below a support point, that's a breakout to the bottom side. So if you are looking to trade a stock on a put contract, or if you want to short a stock, then you're going to look for breaks below significant supports. So for this example, if you are looking to trade on a daily chart, you're looking to trade a multi-day or a multi-week position, then you want to get into Apple below the most significant resistance or support in this case that the stock has bounced off before. So if you're waiting for Apple to enter a short position, then you're going to find your most recent support, which is 149.85 here in this case, or 150. And when the stock breaks below 150, now you have your cue to start entering the stock. And this is where the with the retest and without the retest becomes important. So here in this example, Apple breaks below 150, which we know based off this massive bounce that it got after bouncing above 150. Now that it's below it, the stock is in trouble, because look how long it consolidated above 150. You can see that it stayed between December here in this case, or even longer than December, above 150 all the way through May. And this is just based on the last year's chart. I'm sure Apple had been above 150 for quite a while before this year. In specific. So here in this case, Apple is consolidating above 150. It's above it for months. And so now we know if the stock breaks below 150, all these buyers who are above 150 are going to start letting go of their positions. So here in this case, you can see that Apple breaks below 150. Now, you can be the trader that enters right at the break and you don't wait for a retest, or you can be the trader that waits for the retest and then enters. And so here in this case, what we mean is if you see the stock break below 150, you can enter the stock and you can place your stop loss above 150, but that would be a high risk trade because we don't know if it's going to hold below 150 yet. So when a stock breaks below a support point, that support point should automatically become a resistance point, and the stock should not break back above it if you are looking to bet against the stock. If you are looking to bet against the stock, by all means, you want the stock to recover back above that point in order for it to move back up. But when a stock breaks below a support point, that support automatically becomes a resistance. So here in this case, this 150 break turned this point from this support into this resistance. Now you can enter right on the break and set your price target appropriately, or you can wait for the stock to bounce, and if it bounces and gets rejected at that point, then you can enter the stock for a short position at that rejection. So here in this case, you could have entered here on this break and took your profits somewhere around here, or you could have waited for the stock to get rejected again and prove that it cannot indeed get above that 150 mark. And that point, you can enter the short, and your stop loss on both strategies would still be right above 150. So remember, now that the stock is below it, if you're in a short position, you don't want it to get back above. So here in this case, you're going to place your order to place a short or a put position on the stock once you see it get rejected at 150, and then you're going to get moved back down. So remember from our candlestick charts or candlestick patterns and types of candles, we know that this is a reversal candle. So when you see a stock that looks like this, you know that it's a reversal candle, and therefore you know that once you see a stock that looks like this at the top of a trend below a resistance point, then it can potentially point into a reversal. And so in this case, that worked out perfectly, and that's just combining the elements that you would learn about the market.